Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast. I'm your kind of host, Matt Halloran. Since these are mostly the Mark and Chuck show, I'm just here to add color as needed. Today, we're doing a part 2 of our 2-part series, Bias. Who, me? So here we go, guys. Let's go. Who's taking it over? Chuck, you starting this puppy?
I think I can start off. My goodness gracious. This is, I think, the start of a new year. And we might as well go back, Mark, to what is attributable to investors not meeting their goals, right? And it's their biases. So I got 3 of them on tap for you today. I'm going to, if you don't mind, give kind of the academic definition of each of these 3. I'm going to ask you to speak to them and why clarity overrides all 3 of these. So here are the 3. The first one is over diversification. The second one is herding. And the last one is media response, also known as confirmation bias. So how about if we tee up over diversification? So I'm going to give you, Mark.
Hey, wait a second. Isn't that third one, the media bias, shouldn't that be called hot air?
Yes, that's also another AKA, I guess. So we got media response, confirmation bias, and hot air. Why not, right? I love it. Levity always brings this stuff down to an area where people can have fun learning.
You got to have fun.
Yeah, you do. So you and I like Motley Fool, right? So I got this definition off their website. So I'm going to read this, and then I want you to speak to just this bias is kind of insidious, because you know that when we deal with advisors, a lot of them define themselves as asset allocators, right? And
yes,
their job is to diversify across the board, and we believe they do a lot too much of this. So here it is. According to Motley Fool, it's possible to have too much diversification. Over-diversification occurs when each incremental investment added to a portfolio lowers the expected return to get a greater degree than associated with the reduction in the risk profile. In a sense, an investor can hold so many investments that instead of diversifying their portfolio, they've engaged in a bit of diversification, in quotes, that's Motley Fool's, where their portfolio is worse off because there's no added benefit to the incremental investments owned above a certain level. So there you go. Take that away.
Wow. Well,
isn't that good?
There's talking about putting it on the tee for me this early in the year.
You're going to love it.
Well, academic studies actually, look, there's so many things I want to say here. Academic studies have shown that that an appropriately diversified portfolio is anywhere between 20 to 40 companies. Once you get over 40 companies, you start diluting the risk profile. In other words, you're not gaining any benefit by having more than 40 companies. And what, as Motley Fool is saying, you actually increase the risk of lowering your return from being over diversified, over diluted. There's a lot of theories about this. Most financial advisors are not money managers. They are advisors. They're guides for their clients, and they don't manage money. And they rely on the strategy that you and I have talked a lot about, which is modern portfolio theory. And because they don't manage money, what they end up doing is hiring other money managers to manage the money. And they do that by buying ETFs, exchange traded funds, or mutual funds that have managers that manage buckets of money so that the advisor can pick the funds they want to pick in to get them the quote unquote modern portfolio theory asset allocation. The problem with that is, as we've done analysis on many portfolios like that, they end up owning hundreds, if not thousands of stocks. I've seen portfolios that have 250 on the low side to 20,000 on the high side. Now, some financial advisors will say, I believe that most money managers can't beat an index.
Not true.
And so therefore, I'm going to hire all these managers to spread my risk. So in other words, they're more worried about managing to a benchmark than to actually manage to the client's needs. Right there, you have already put your client at a significant disadvantage because you are managing that client's situation with the wrong resources or the wrong ideas. You never manage a client's needs by a benchmark. You manage to their needs. You manage to their goals. You manage to an expected long-term rate of return. But the problem is, as we've talked about many times before, advisors need to use benchmarks and clients therefore use benchmarks because neither one of them have an adequate rule or yardstick to gauge, is my portfolio really doing the best it can or not? Am I really getting the value paying 1 to 1.5% to this financial advisor and paying 10 bips to a 1%, 2% within a fund to manage my money? And so the investor says, why don't I just go buy an index fund and own that and not worry about anything? But the problem with that is all the other issues: lack of flexibility, lack of clarity, lack of the ability to take advantage of volatility. And so over diversification has become a result of the strategies that financial advisors have been using for decades because of modern portfolio theory. And then you get a lot of people that go out there and say, Chuck, I don't like individual stocks. They're too risky. To which I always say, well, what do you think you own in your mutual funds and ETFs? And they got I don't know who the commercial is.
Yeah.
But eliminate single stock risk in your portfolio. First of all, how about you define what risk means? I've been doing this for almost 28 years. I've never owned a stock, including one of my worst performing stocks, that had a significant impact on our portfolios for 2 years. Not one stock we have ever owned has impacted negatively the long-term performance of our portfolios, ever. We've had a couple companies go bankrupt. We've had a few lose a lot of their value. But at the end of the day, process before progress. That's why we don't believe in benchmarks. The only benchmark we need to do is make sure that we're on track to accomplish the financial goals that we want to accomplish. Remember, academic study, and it depends on what study you want to read. But the advantage of working with Nepsis, as you know, guys, which I've talked about incessantly with my advisors, is you have access to the asset management team. You have access to the money management team, the investment committee. The committee has been together for almost 20 years. People don't leave Nepsis. My investment committee has been with me for that long, and process before progress is what's most important. And so therefore, most investors are over diversified, and therefore they're already, think of it as a track meet. You get into the blocks and the gun goes off, and the gun going off is you starting to work with a new advisor, and he puts you in 15 to 20 mutual funds and ETFs. You're already the last out of the blocks.
You know, I've known you for 17 years and I never heard you use that analogy, but I love it. We got to do a blog and a white paper and a compass on that.
Good.
Mark, you nailed it. I got 3 things that I want to just you to mention before we get to the next bias here. So if I recall, and I think it was your son, Matt, who's our VP of Business Development, saw this commercial. It was actually State Street Spider. It was regarding, hey, this is the XLI, I think it is, the industrial sector, and it eliminates single stock risk. So you guys got me on the horn and said, Chuck, check this out. And do you remember when Dow and DuPont merged several years ago? In that ETF, it was 25% of the holdings within XLI was that large Dow DuPont, because it's a market cap weighted ETF. So here this commercial is touting single stock diversification risk is out, but actually 45% of the fund was in one stock.
Well, the reality is many mutual funds and many ETFs have in their top 10 positions that make up 5 to 10% of the total fund. Yeah. Do you want to know why they do that? That's the only way you capture alpha. But think if you have 5, 10, 15, 20 funds in your portfolio and all of the top 10 holdings, right, make up 50 or 60% of the portfolio, you are still looking at 100 to 200 stocks. That dilutes down the purpose of why a fund or ETF overweights their top 10 holdings, because the more positions you put in the portfolio, the more you're diluting the overall return. And let's be blunt. Let's call it what it is. Financial advisors are not money managers. I always chuckle internally myself. I talk to a financial advisor, and of course, our industry is full of overly confident individuals.
What'd you say?
The least. And I always love how they tell me how they're great money managers. And I always ask them, hey, what's your largest holding? And 9.9% of them say they can't tell me. The other 0.1 says, well, it's American funds. They don't even realize that the largest holding is not a stock. They call it a mutual fund, not an individual stock. So that tells you some of the advice that people get. And I'm coming into 2023 on fire, en fuego. There's no more cutting corners and mincing words. Most financial advisors have no business making decisions on where money should be put, because you don't even know what the money manager running that fund's doing. You don't know what their philosophy and strategy is, or maybe you do, but you don't know if they've ever changed it or not. This is why, on a foundational basis, clarity is the ultimate most important aspect of a portfolio allocation. Period. End of story.
Mark, you answered questions 2 and 3 that I wanted to bring up. I want to get your thoughts on this, and we'll transition to the second one here. So, yes. Morningstar, stock intersection report. How many do we see? What you just nailed, right? Whether, we own the American funds, we own Vanguard, we own BlackRock, we own Fidelity, and the same holdings are in all of those. And sometimes you'll see 9 or 10 funds have the same holding. And it's just we used to call it bubble wrapping the bubble wrap, right? So that you nail it.
Well, what you're basically doing is you're cookie cutting the process. And everyone's own financial situation is different. It's like going to the doctor's office and the doctor telling every single person that comes in, oh, you got a sore throat.
Yeah.
Well, I got a sore throat, but my sinuses are killing me. I've got a fever. Nope, you got a sore throat. You'll be fine. Take a couple of Advil, call me in the morning. Not every situation is the same. And unless you can have ultimate flexibility, ultimate transparency in the decisions you make, you are already, to use the analogy I did earlier, you're already coming out of the blocks in last place. You're coming out slow. I always say to people, when you put your money into investments, don't you want every possible advantage you can get? And every single person says, of course so. Of course I do. Well, knowing what you own, knowing your allocation, knowing what businesses are in your portfolio, I think without over diversifying, you're coming out of the blocks hot. You're going to be in the lead.
So I'm going to end on a quote from the king here, and I want you just to make a slight comment. We'll pivot here. So Warren Buffett, when once asked, but in a critical manner, you only own 6 or 7 businesses publicly traded. He owns numerous ones that aren't, that are private. But asked about that, he said this, and I want you to comment on this, Mark. Why diversification is only required when investors/advisors do not understand what they are doing. Now, how profound is that, right? And that's the whole understanding what you own and why you own it, the Nepsis Clarity message.
Well, this is why I always say to investors, you have to realize at the end of the day, whether you are in a mutual fund or you're an exchange traded fund, you are a business owner. That's not an opinion. That's a fact. You are a business owner. And the percentage of each business that you own is dependent upon how much money you've put in and what the allocation is of that portfolio. And when you own, let's just be conservative and say you own 1,000 stocks. 90% of those positions are going to make up less than 1% of your overall portfolio. Can you imagine if every single publicly traded company had 90% of their sales come from less than 1% of their product success? They wouldn't be in business.
Yeah, absolutely.
And so the point that Warren Buffett's making is when you know what you own, you know the businesses you own, you understand what makes a business successful, you don't have to own 200 stocks.
Amen.
You don't have to own 200 companies. And frankly, when you have this kind of conversation with people who own private businesses like you, like Matt, like myself, we're our largest assets in our business. And we're pretty dang comfortable with it. That's the power of knowing what you own and why you own.
I love it. But let's transition to number 2 here. So, take a break there, a little bit of, a sip of water if you want. You nailed that one. I know you're going to nail this one. So I'm going to give kind of 2 versions of this definition of herding. Okay. So one comes from capital.com, the other from our friends at Investopedia. So here we go. Herding, which is also known as the bandwagon effect, is a psychological phenomenon in which people rationalize that a course of action is the right one only because everyone else is doing it. In the world of investments, this can take the form of panic buying or selling. Herd behavior is a human nature and is often discussed as a cause of investment bubbles. A good example would be the dot-com boom of the late 90s when people continued feverishly investing in internet companies despite the fact that many of these startups were not financially sound. So here's Investopedia. A behavior wherein people tend to react to the action of others and follow their lead. This is similar to the way, think about this, Mark, animals react in groups when they stampede in unison out of the way of danger. Perceived or otherwise, herd instinct or herd behavior is distinguished by a lack of individual decision-making or introspection, causing those involved to think and behave in a similar fashion to everyone else around them. So how do you like that for another teeing up?
I mean, yeah, you realize that Christmas was almost a month ago. I mean, you're giving me Christmas in January.
Why not?
You always give me nice gifts, so thank you. Look, the reason why people have a herd mentality is because they don't have an investment philosophy and an investment strategy. They rely on the emotional predisposition of how the human mind and human body works. That's why we believe that the majority of the investment decisions that are made by investors are made emotionally and not fundamentally. Animals are born with the instincts to a herd mentality. Okay.
Yeah.
People are not. But people listen. It's kind of like Pavlov's dog. When you ring the bell and you put the water and food in front, they know when you ring the bell, they're going to the water and the food. And people have been trained to listen to emotional things so that when the bell rings, they all run to the water. But people are not dogs. People have a higher level of intellect. The problem is that there's a lot of issues psychologically about investing, but one of them is intimidation. I don't understand investing. Hey, I don't blame you. If I own 5, 10, 15 mutual funds, and it all starts with your 401k when you check boxes. And how many investors listen to this podcast, go to the 401k plan they just got into, and they look at the historical returns, and they go and they pick that fund because it's got the best past performance. Investors are being trained to make bad investment decisions. Let me tell you that one more time. Investors are being trained to make bad investment decisions. Why? Because when they do, if they do, the knight in shining armor comes to their rescue, and they turn on the business news that gets paid lots of marketing dollars and advertisements, and you sit and you listen. If I got to freaking listen to another Tesla thing that I've listened to for the last 2 months, I'm going to die. There's more companies in the market than freaking Tesla or Meta or all these other 3 other names that they keep mentioning every single day.
It
Process before progress. What is the investment process?
And I love that. And that's what I want to do is just unearth that a little here. And then we'll move to the last one here. I want you to speak to kind of the elixir, the remedy to this herd mentality, right? Following the crowd is process. And think about that discipline process, that 4 keys, Mark, that we talk about, which is really the blood flowing through the Nepsis body, if you will. We got philosophy, a sound philosophy, a structured strategy, and then that allows for unfettered flexibility and ultimate transparency. And it really frees that individual from feeling like they have to follow the herd because they have nothing else to rely upon. I want you to speak about that if you can.
Well, first, at the top of my mind, flexibility. What I believe at the end of the day, philosophy, strategy, flexibility, and transparency, they're all equally important. But if I had to choose one, I'd say flexibility. I'm waiting for you to finish your research, your team, and the research on the alpha creation from flexibility. You cannot put a dollar value on the power of flexibility, just like you cannot put a dollar value on the value of clarity. And process is a result from the philosophy, strategy, flexibility, and transparency. And think of it as a funnel. And when it all funnels down, at the bottom of the funnel, the smallest part, which the least amount of people have, is clarity. And all of those pieces funnel down to ultimate clarity. That is the power of Nepsis. That is the power of clarity. Can you put a price on clarity? Can you put a value on clarity? At the end of the day, clarity is the single most important aspect of investing. But to get to clarity, it's not linear. There are components that have to come into play. What is that investment philosophy? What is the strategy? What is the amount of flexibility and transparency that you have? Philosophy and strategy are the empirical components of investing. Flexibility and transparency are the behavioral aspects of investing. All of those components come together with a buy and sell discipline to get you to what you call your investment process. Process then funnels down. Once you understand the process, know the process, live the process, and execute the process, you are now just beginning to live with clarity.
Boy, the ultimate goal for investors. I love it, Mark. So very well said. Let's get to the last one, my friend here. Media response, also known as confirmation bias, or Mark Pearson basically said hot air, right?
Yes.
I'm going to give you...
Yes.
I'll give you a long-winded, if you will, definition here. So we got Investopedia again. So listen just to this, and I think this is the third one you're going to tee this up, and with the bases loaded and hit a grand slam as we finish this up. So confirmation bias is a term from the field of cognitive psychology that describes how people naturally favor information that confirms their previously existing beliefs. Experts in the field of behavioral finance find that the fundamental principle applies to investors in notable ways, because investors seek out information that confirms their existing opinions and ignore facts or data that refutes them. They may skew the value of their decisions based on their own cognitive biases. This psychological phenomenon occurs when investors filter out potentially useful facts and opinions that don't coincide with their preconceived notions. So I'll tee a couple of them up. We've learned them over the years, right, Mark? The first one is this bifurcation politically that we have, this phenomenon in the United States, right? When you poll Democrats when a Republican is in the White House, they believe the economy is much worse, and vice versa. That's number one. And number two is this insatiable desire to conflate the national debt or the disagreement with the way that Congress has managed the coffers of the U.S. and to equate that to a meltdown in the stock market and to move to owning gold or other assets, in this mindset that disallows people to use what we would call logical or fundamental factors in owning businesses. So I'd like you to speak to that if you could.
Well, I think it's common sense. When you were talking about the political part, I was already 3 steps ahead of you to the extent of saying, think about family, think about the holidays, and everyone got together for Thanksgiving and Christmas. And I don't know what the percentage is of families that when they get together, inevitably a political fight breaks out. And on the left side, you have the blue team, the Democrats, and on the right side, you have the red team, the Republicans. And when the Republican person speaks, all the other Republicans go, ooh, yeah. And when the Democratic person speaks, ooh, all the Democrats just love and think they're the smartest thing since canned beer. The reality is there are advantages to both. And the problem is that people become so emotionally tied to what they believe in that they don't have the ability to discern both sides and figure out how to make both those sides work. Because you can't tell me that if you're a Democrat that the Republicans don't have some good ideas. You can't tell me if you're a Republican that Democrats don't have some good ideas. And so at the end of the day, we do inherently listen to what makes us feel better or what makes us think we are smarter.
Yeah.
And at the end of the day, it doesn't mean jack squat. There's my point for you.
Well, you nailed that. And what I want to do is I want to pivot to this last point here, because this is really, the T is getting much higher. And you remember back in your old baseball days, right? So here's an issue that I have with confirmation bias and this constant beating the drum of the stock market, the market. I want you to end on this, the stock market, or is it a market of stocks? And I want you to speak that because, and I'll use the word conflating again, this conflating the national debt or the dissociation of political parties in power with the market is going to crash. And we resonate towards that. And I think that people take a mighty leap in that mindset if they were to just understand the underlying pinnings of a business and what you're paying and what you're getting, that would eradicate. And that's clarity. So talk about that, this stock market versus what is really a market of stocks, if you will.
Well, first of all, I don't like calling them stocks. I like calling them businesses. The stock market is nothing more than the greatest tool ever created to bring buyers and sellers of businesses together. And there could be many reasons why someone wants to sell a business. That's where you get creation of value. Remember that value of a company is relative. Price to earnings ratio, people talk about a lot, price of sales, all these different factors. But at the end of the day, first and foremost, a valuation is relative. The value of a business is only what someone is willing to pay for it when you're selling it. Okay. So the stock market is nothing more than a big cloud that people can meet in to buy and sell their businesses. Okay. That's number one. Number two, when you think about the idea of investing with clarity or the idea of investing in a business, you do have to have some metrics available to you, a philosophy and strategy that enables you to garner and gauge the future value of a company for which you are paying for today. When you invest in a business, you're not looking at what that company's value is going to be in a year or 2 years. You're looking at 3, 5, 10, 20 years down the road. And so people have this mindset of, I invest in the stock market and the market's going to crash. Well, I'm going to tell you, a lot of people lost 20, 30, 40% of their portfolios last year. We didn't. So you would argue then we didn't invest in the stock market using that old theory. We invested in businesses. And it's the value of businesses and the process to which you adhere to determine what the future value of a business is that's going to allow you to stick to process, stick to the knitting, and invest with clarity.
Boy, Mark, I love it. Which wrap it up on this because we have a thing we call clarotology at Nepsis, right? The study of clarity. Business ownership is the foundational component. And I love to see investors, when the light bulb goes on, when they actually understand that when I own shares in a company, that I'm an owner of that business.
Correct.
Maybe not to the percentage that Buffett is for certain, but I'm an owner and I got the right to future profits, right? Which really work themselves into price appreciation, hopefully. And if the company pays a dividend, I got my quarterly check for loyalty of ownership. And we've lost that dramatically. You just listen to the business channels as you and I do, and how many times do you hear the market, the market, the market, the market? I would love to calculate that number when they don't talk about here's a business and why do you own that business?
Yeah. Here's what I'll say. Number one, it's, Warren Buffett is getting older. And
he's 90.
He's not on TV nearly as much anymore, which is really too bad because he is a voice of reason when it comes to the masses and talking to the masses about investing, right? And I do think that the world we're living in, investors are becoming less and less engaged in understanding what is really happening. On one hand, the availability of information and data to make an investment decision is crazy compared to when I first got into this business or when I first started investing. The amount of information, the amount of knowledge, the amount of access to information has gotten so much dramatically better. And as a professional, I would say, obviously, that's tremendous. That's hugely beneficial for myself and for my team and my clients. Unfortunately, it is also a detriment to people who act more emotionally and don't have a process. And it enables them to make bad decisions much quicker because they can click a button and sell a company for free and not realize the long-term ramifications of doing that. Secondly, you made the point about owning shares of a company. Let's face it, 19, 20, and 21 were very, very good years overall for the economy and stock price appreciation. 2022 was the worst year since the financial crisis. And we got a lot of new clients at Nepsis last year. And one of the things that our advisors do, as we've told them to do, they constantly do, is these new clients, they've only been with Nepsis for a year, and they're looking at, holy cow, my portfolio's down because Puff the Magic Dragon, it should go up every day. So how do you counteract that? You show them how many shares they had at the start of the year, and then you show them how many shares they have at the end of the year. And they all notice that they own more shares of a great business at the end of the year, and the economy will improve. And great run companies will continue to grow and be profitable. And I cannot tell you how many times I've done strategic cost averaging where I've bought more shares of a great business that longer term dramatically enhance the client's investment portfolio. That to me is one of the greatest functions of flexibility, transparency, and ultimately clarity.
Well, sum it up like this, Matt. I'll pass it back to you to close. I think Mark nailed it once again. Clarity slays the three biases that we spoke about: over diversification, herding, media response, and confirmation bias. And hopefully our audience took that to heart. So I'll pass it back to you, my friend, as you close us down.
Yeah, I'm sitting here and nodding wildly because first off, I think diversification or diversification from Motley Fool is a fantastic word. And oh my goodness gracious,
this came up with it.
I know that would have been great. Yeah, that would have been trademark quick on you guys. So I love we've talked a lot about over diversification. This idea of herd mentality, terrifyingly true and accurate. As a recovering therapist and somebody who studied psychology, this is something that is very, very important. And one of the reasons why this podcast is so vital for not only for you to listen to it, but for you to share it. We need to change the herd mentality here. And the best way to do that is you as a listener of the show to share it with a friend and say, hey, look, things are not the way it seems. You have to actually look at what it truly means to invest with clarity. And then the last part here with the media response, I interviewed somebody earlier today. He's a PhD behavioral psychologist, works for a very, very large company. And one of the things that he said on the show today was the average investor expects a 17% rate of return in 2023 because of recency bias or media response, right? And, when you're consistently hearing at the end of every news show, the Dow's up 42% or the Dow's up 42 points, which means nothing, right? And it's like 0.0001% of anything, that's the sort of ridiculous stuff that this podcast, what you guys do at Nepsis, is truly trying to combat that. And all of you who are listening need to help us get this word out. So with that, for Mark and Chuck, this is Matt Halloran. We'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC registered investment advisor.